Hi everyone, so my name is Zach Vines, and what we're looking at today is an area of accounting that gets into something a bit more complicated. I know I was struggling with it at first when I very first learned it, and that is the statement of cash flows using the indirect method. So what I want to do is just provide you a high-level overview to begin with, kind of wrap your head around the purpose of what we're doing, then show you the framework for the more nuanced portions of it to sort of wrap everything up. So first of all, when we're talking about the statement of cash flows, remember we're literally talking about physical cash, right? And when we're looking at the statement of cash flows, it's organized by three different activities: operating, investing, and financing activities. So I have another video, I'll put the link in the description, that details exactly how to tell whether or not you're dealing with an operating, investing, or financing activity. That should be pretty well understood before you get to this point, so I'll definitely link and timestamp that for you. But you know, it details basically by activity what happened in your cash account that results in your cash ending balance on your balance sheet. So you began the year with some amount. All of these things happen throughout the year. That's known as your change in cash, and then that is added to your beginning cash to give you your ending cash. So what makes the indirect method fairly unique is that instead of us, as a large company taking account every little transaction as it happens and impacting exactly how that's going to impact the statement of cash flows at a later point in time, which just costs a lot of time, a lot of money, a lot of resources dedicated to figuring out exactly how to manage everything to do the direct method. The indirect method is sort of a way of us backing into our cash number for us to look at our, start with our accrual basis net income, take into account just different changes in accounts that explain the difference between the accrual basis net income and the cash basis net income that all funnel into a final change in cash number. It's going to seem kind of complicated at first, but that's the more nuanced section that we'll get to in a moment. So just to show you the general format of a statement of cash flows under the indirect method, we have it broken into operating activity, investing activity, and financing activity. So one thing I want to say kind of out the gate is that the investing activity and the financing activity is going to seem a bit more straightforward than the operating activity section, because there's no such reconciling we have to do for those sections like we have to do with the operating activity section. It's literally just a matter of looking at certain accounts and going, okay, for instance, with investing activity, we bought some land. Well, when you buy land, you buy any sort of long-term asset, that's going to be considered an investing activity, assuming that you bought it in cash and this is indeed a cash activity. So you're going to just take those sorts of things into account where, that would be a cash outflow. Selling equipment is an investing activity. That'd be a cash inflow. And all of those are going to net out into a net cash from investing activity. Okay, so I did have to change one thing. I accidentally wrote the same thing twice right here. But now that we're looking at the financing activity section, that would be things like, we issue stock. So we see that our common stock increased, which is going to be a financing activity inflow. So we have an inflow for cash right there. We receive a loan and we have immediate inflow of cash that is considered a financing activity. You're going to have a plus right there. And you net all of those values into a final net cash from financing activity. Now, we'll get into the operating activity thing in just a second, because that is, I say, the hardest part about the entire indirect method is sort of the framework at play and how to take that into account. But the big picture here is once you have all of your net cash flows from each of those activities, from your operating, investing, and financing activities, you just take them, net them into an overall increase or decrease in cash. So, if net cash from operating activities was a large inflow, this was a small outflow, this was another large inflow, you kind of add them all together and just net them into one amount that is, in that situation I just described, going to be an overall inflow of cash, and you're going to add that to your beginning cash balance, and that should yield the ending cash balance that shows up on your balance sheet. And if it's not the same number, really, the balance sheet figure is your check digit to make sure you did it appropriately. So if you have all the information that you need and you went through those steps and it doesn't equal the cash balance on the balance sheet, something probably went wrong somewhere along the way. So that should give you a overall broad overview of how the statement of cash flows works in the first place and kind of what we're doing at a high level. But it's that operating section that gets really tricky and trips students up when we first look through it. I know I certainly did when I was first learning it. So let's drill down all the details on that, and that should wrap things up. Okay, so now we're specifically going over the operating section and kind of what makes the indirect method unique in how it handles this operating section. So here's the framework for everything frankly, if you wanted to just follow everything I have written down right here and not really think about the inner workings of it, you probably could get the right number. But the thing is, if you just memorize this and you don't have sort of at least certain key examples to hold on to understand exactly why increases and decreases in certain accounts affect the statement of cash flows the way it does, then if you just forget one thing you memorized, then the whole thing falls apart. And so let's kind of go through the framework at a high level and then go over why some of those sections are the way they are so we can make sense of it. So basically what we're doing when we're reconciling the operating activity section, we are starting with our accrual basis net income. And remember, when we're dealing with accrual accounting, you recognize revenues when you earn them, and you recognize expenses when you receive the benefit of the expense that you incurred. So it's not necessarily related to the cash, right? So you might earn revenue by making a cash sale, and those would be one-to-one, but you might also earn revenue by making a sale on account, which didn't involve cash, yet it still impacted and increased your net income because you recognize revenue. And so what we're doing is starting with the accrual basis net income, we take into account what changes, or really what the difference is between the accrual basis versus the cash basis. And keep in mind, cash basis is just like recognizing revenues when you get the cash for it, regardless of when you actually earned the revenue. And expenses are going to be when you paid the cash for it, regardless of when you recognize the benefit from the expense. So taking those differences into account, going from the accrual basis to the cash basis, takes that into account so you end up with your operating activity cash flow section. So you start off with your accrual basis net income, and you're going to subtract any gains that you had and add any losses that you had. So I just want to go through that really quickly, and then we'll explain why. Then you add or subtract, depending on what's going on, your changes in your current assets and your current liabilities. I want to make a very specific point that it's the current assets and current liabilities that you do, not anything like buildings or land or equipment or anything like that. It's things that are usually going to be settled within a year, maybe accounts receivable, inventory, just nothing that's going to be considered long-term in nature that lasts a year or longer. And then you add back non-cash expenses. I say depreciation there just as an example, but there's amortization expense as well, and just other non-cash expenses. And when you take all those into account, that will result in your net cash flow from operating activities. So this changes in current assets and current liabilities. If you follow this framework right here, you should be just fine. So if there's a change in a current asset, so we're talking about a current asset right here, if the current asset increased, you're going to subtract that from your accrual basis net income to reconcile it to the cash. And if it's a decrease in your current asset, you're going to add that to your net income to reconcile the difference. If it's a change in a current liability, let's say it increased, you add increases in your current liabilities to your net income, and you subtract decreases in your current liabilities from your net income. So here's the way I like to think about that. Let's sort of go piece by piece to sort of explain everything. I have some examples down here, but let's talk about the gains and losses first. So if you're going from the accrual basis to the cash basis, you're going to subtract gains. Well, why would that be the case? Well, let's think. When we're coming up with our accrual basis net income, a gain is basically like a revenue, not in the sense that it's going to show, you know, it's not like, I'd say it's like a revenue in that it impacts net income similarly. It's not considered a revenue. But when you have a gain, it adds to your net income, right? Well, the nature of a gain is that it's non-cash involved. Like an example of a gain would be if I had some asset that's been depreciated over time and my standing book value for that asset is, I don't know, $100,000, let's say, and I sell that asset for $150,000, okay? The gain there is that $50,000 difference between what it was valued for on my books versus what I was able to sell it for. But that $50,000 doesn't tell us anything additional about the cash we received. The cash we received is the full $150,000 from selling it. That gain of $50,000 that did impact our net income really wouldn't have added anything additional to our cash basis net income, right? So don't include that if you don't need to. It's the same thing dealing with the loss as well. Let's say it was valued at $100,000, I sold it for only $50,000. That loss is just impacting our accrual basis net income by saying that it was less than what it was valued for on the books. What we sold it for was less. So that wouldn't have additionally taken away from our cash basis net income. So add it back so we know what our cash basis would be. So let's go ahead and talk about the non-cash expenses as well. So you add those back. So why would that be the case? Well, something like depreciation, let's say. it's not a cash expense because the reason you depreciate an asset is because you purchased it and you're allocating the expense associated with that asset over its useful life. So all the cash was paid up front. Really, under a cash basis, we would have recognized all the expense associated with that asset right when we purchased it. It's just under accrual basis, we're allocating the benefit we receive from that asset over a period of time. So each year, when we recognize a depreciation expense that doesn't have a coupling cash amount apart from just the initial first amount that we made in the first place, that took away from our net income every single year. Well, under cash basis, we wouldn't have taken that depreciation away from our net income, from our cash basis net income every single year, because we already took that into account forever ago. So if we shouldn't have taken it away, let's add it back to get to our cash basis. So you can kind of see a trend here. Just go, okay, how would I get from the accrual basis to the cash basis? And just add or subtract accordingly. So this whole chart right here, I would recommend relying on it instead of very case by case looking at a current asset, a current liability, and trying to think about exactly why it would be that we would add or subtract it from our net income. These are some good examples to help you wrap your head around, but I would hold on to those examples as a tool to remember the chart as opposed to remembering every single situation and having to analyze it, because this is a very good rule of thumb thing that you can use as opposed to having to spend all the time and energy to look at it very case by case every single time. So for instance, let's say I make a sale on account, right? So my accounts receivable increases because it was not a cash sale. So I increase my receivable when I make a sale on account. And my revenue increases, right? Well, under a cash basis, no revenue would be recognized right there because I never earned any cash for it. And under cash basis, I don't recognize a revenue until I receive the cash for it. So under the accrual basis, I recognize an increase to my net income. Well, if I want to go back to my cash basis, I shouldn't have added that revenue in the first place until I received the cash. So if I see that we had an overall increase in our accounts receivable, I'm going to subtract that from our net income because I'm going to assume that the difference between our cash basis and the accrual basis is that change in the accounts receivable. And thus, you would subtract it from your net income. And then let's say we're doing a salaries payable. So we have an overall increase in our salaries payable. Well, when you do that, your salaries payable increases because that's a liability, and you increase the associated expense with it. Well, if the expense increases, that decreased our accrual basis net income because a higher expense means lower income, right? So a higher expense yielding a lower net income under accrual basis, we wouldn't have recognized that expense under cash basis because we never paid the cash for it yet. So if you wouldn't have done that under the cash basis, you wouldn't have subtracted it, add it back. So it is what it would have been if you were taking that into account. So those are two pretty good examples to make sense of some of the situations here, but I would just mainly hold on to that chart as a tool to use when reconciling this. So again, we're just going to touch on this operating activity section format, and that should wrap things up. We're going to start with our accrual basis net income right here. These are just two examples like directly from right here, where we had an increase in accounts receivable. Because that was an increase in a current asset, we subtract it from our net income to reconcile to our operating cash. Then when we have an increase in our salaries payable, which is what we had right here, an increase in a current liability means you add it to your net income, which is exactly what we do. If we have a gain that we recognized, you're going to subtract that from your net income. When we have a non-cash expense like depreciation, you're going to add that to your net income. And you're going to look at pretty much every line item, every current asset, every current liability, analyze the changes in them, apply it to this chart, and plug it into the statement of cash flows accordingly. Take into account your gains, losses, your non-cash expenses, and that should all net into your net cash from operating activities. So at that point, once you have your net cash from operating activities, again, kind of going back to the beginning of the video, that's one of the three net cash from a certain activity line items that you need. You'll have the operating activities section, the investing and the financing activities section, which would be a little bit more straightforward than this whole process. You net all those together into one overall change in cash, then apply that versus the beginning balance, and that should give you your ending balance, which is going to check out on the balance sheet. So lots of moving parts here, but if you just applied this framework, I hope my explanation helped out. So thank you so much for watching, and I hope that helped.